Tonight we slow down and look at something almost no one notices. A hidden system shaping every country, every market, and every hour of your day. The world now carries more than $315 trillion in obligations. But here is the part that never makes headlines. Most of this debt isn't owed to someone else. It loops quietly inside the system itself. If that sounds impossible, stay with me. Because once you see how these loops really work, you'll understand the global economy in a way most people never will. So the real question isn't who created all this debt, it's who it actually belongs to.
Welcome to Late Economics, where economics becomes clear through the ideas and moments that shaped our world. Subscribe for more.
Let's begin with a number. $315 trillion. That's the total debt carried by governments, companies, and households across the planet. Nearly 3 times larger than the combined economic output of every nation on Earth. If you try to visualize it, the number loses meaning. It's too large, too abstract. But debt isn't really about the number. It's about what the number measures. Think of debt as a pressure map, like atmospheric pressure on a weather chart. It shows where economic activity concentrates, where capital flows, where promises accumulate. High debt doesn't always mean danger. Sometimes it means capacity, the ability to mobilize resources, to build, to invest, to expand. Low debt doesn't always mean safety. Sometimes it means stagnation, the inability to borrow, to grow, to respond to change. Debt measures how much a system can stretch, how far promises can extend before they snap. Now here's what makes this strange. As economies grow richer, debt grows faster. You might expect the opposite, that wealth would reduce the need to borrow. But the data shows something different. The United States is wealthier today than 50 years ago, yet its debt has multiplied. Japan is one of the richest nations per capita, yet it carries debt exceeding 250% of its economy. Germany, France, the United Kingdom, all prosperous, all deeply in debt. Why? Because modern economies don't run on savings alone. They run on credit, on the ability to pull future resources into the present. A company doesn't wait until it saves enough to build a factory. It borrows, builds now, repays later from production. A government doesn't wait to collect taxes before funding infrastructure. It borrows, builds roads, pays interest from future growth. This is how growth accelerates, not by waiting, but by borrowing against tomorrow. Debt becomes a tool, a technology, a way to collapse time. And when everyone uses this tool, debt expands, not as a burden, but as a map of ambition. But there's a deeper layer, one that confuses most people. If everyone owes money, where does it come from? Who has the surplus to lend? The answer isn't intuitive, because the system doesn't work like household budgets. When banks lend, they don't transfer existing money. They create new money, digital entries on balance sheets. When governments borrow, they issue bonds. Those bonds become assets for whoever buys them. One person's debt becomes another's wealth. So the total debt keeps rising because every loan creates both a liability and an asset. The two sides balance, but the total grows. This means the 315 trillion isn't owed to some external party. It circulates within the system, like blood through a body. Countries lend to each other. Banks lend to governments. Governments guarantee banks. Central banks lend to everyone. It's a closed loop, a network of obligations that reinforces itself. And here's the key. The loop only works if everyone keeps participating. If one country refuses to borrow, it loses access to capital. If one bank stops lending, credit freezes. If one central bank withdraws support, markets panic. The system depends on continuous motion, on perpetual circulation. Stop the flow, and the pressure drops. The economy contracts, growth halts. This is why debt never disappears. It can't, because modern economies are built on it, not as weakness, but as architecture. The 315 trillion isn't a mistake. It's the scaffolding that holds everything together. But scaffolding needs maintenance. It needs trust. It needs belief that tomorrow will honor today's promises. And that trust doesn't come from nowhere. It has a history, a beginning. Let's go back to where this system started, to the moment when debt became infinite. In 1694, England faced a problem. War with France was draining the treasury. Gold was running out. Taxes couldn't keep pace with military spending. The king needed money, not just once, but continuously, for years. Traditional lenders wouldn't help. Loans to monarchs were risky. Kings defaulted, lenders lost everything. But a group of merchants proposed something new, a mechanism that changed finance forever. Instead of lending gold directly, they would lend against future tax revenue. The government would promise to pay interest, forever, backed by its power to tax. And here's the revolutionary part. That promise could be sold, traded, transferred to someone else. It was called a bond, a financial instrument, a claim on future wealth that could circulate like currency. This created something unprecedented, infinite credit. Before this, lending was limited by existing wealth. You could only lend what you already had. But now, you could lend against what would exist later, against production not yet created, against taxes not yet collected. It was a time shift mechanism, pulling the future into the present. The government could spend now, build armies now, fight wars now, and pay later from future economic growth. This required a new institution to manage the bonds, to ensure the promises held, to maintain the system. They called it the Bank of England, the world's first modern central bank. Its job wasn't to store gold, it was to make promises credible, to convert trust into liquidity. And it worked. England borrowed, funded its navy, expanded trade routes, built an empire, all financed by bonds. Other nations watched and copied. France created its own system. The Netherlands refined the model. The newly independent United States adopted it to fund revolution. National debt became normal, expected, essential. But the implications went deeper than anyone realized. Before bonds, power came from controlling resources, land, gold, territory. After bonds, power came from controlling promises, from the ability to borrow, from creditworthiness. A nation that could issue bonds at low interest rates had flexibility, could respond to crises, could invest in growth. A nation that couldn't borrow was trapped, limited to current resources, unable to mobilize future capacity. Credit became sovereignty. The bond market became the arbiter of national power. And here's what made it permanent. The promises were never meant to be fully repaid. The original bonds issued in 1694, some of them remained on Britain's books for centuries. Interest paid continuously, principal rolled over, again and again. The system wasn't designed for repayment. It was designed for refinancing, for perpetual renewal. This created a strange new reality: debt without end, but also growth without limit. Because if you could always borrow more, you could always invest more, build more, expand more. The constraint wasn't money, it was trust, belief that the promises would hold. And as long as belief held, the system expanded. By the 20th century, every major economy operated this way. Perpetual debt, perpetual refinancing, perpetual growth. The 315 trillion didn't appear overnight. It accumulated over centuries through countless refinancings, each generation borrowing against the next, each era pulling future resources into the present. And the mechanism that started in 1694, it's still running, still creating debt, still converting tomorrow into today. Let's talk about what bonds actually do. A bond isn't just a promise to repay, it's an information conduit, a signal that travels through markets. When a government issues a bond, it sets an interest rate. That rate communicates something about risk, about stability, about the market's collective judgment. If the rate is low, the message is clear: we trust you, your economy is stable, your promises are safe. If the rate is high, the message shifts: we're nervous, we need compensation for risk, prove you can pay. This happens continuously, every day, across every market. Bond yields move, sometimes slowly, sometimes violently. Each movement carries information. Investors watch these signals. They adjust, they buy, they sell, they hedge. And through millions of individual decisions, a consensus forms about which countries are safe, which are risky, which are somewhere in between. This consensus becomes real. It determines borrowing costs. It shapes policy. It influences elections. A government that loses market confidence faces a choice: reform or collapse. Because once yields rise too high, refinancing becomes impossible. The debt spiral begins, and there's no escape without external help. This makes bonds more powerful than armies, more influential than diplomacy. A nation can win wars but lose bond market confidence, and the loss can be more damaging than any military defeat. Think about what this means. Financial markets have authority that transcends borders, transcends governments, transcends democratic will. A country elects leaders, but if those leaders lose market trust, their options shrink dramatically, immediately. This isn't conspiracy. It's structure, the way the system was built. Bonds replaced gold as the foundation of trust, and bond markets replaced kings as the source of financial authority. Now here's where it gets complex. Bonds don't just signal trust, they create it. When a government can borrow cheaply, it gains options. It can invest in infrastructure, education, healthcare.
Those investments improve productivity. Productivity increases tax revenue. Higher revenue makes the debt sustainable. So low interest rates enable growth, and growth justifies low rates. It's a reinforcing loop. But the loop can reverse. If markets lose confidence, rates rise. Higher rates drain revenue. Less revenue means cuts. Cuts slow growth. Slower growth increases deficits. Larger deficits erode confidence further. The same reinforcement, but in the opposite direction. This makes bond markets incredibly powerful. They don't just reflect reality, they shape it. A loss of confidence becomes self-fulfilling, not because the underlying economy collapsed, but because the market believes it will. And here's the strange part. Nobody controls this. There's no central authority, no single decision maker, just millions of investors, each responding to signals, each making individual choices. Together, they create collective judgments, and those judgments move nations. This is the architecture we live in, a world where government bonds carry more authority than government itself. And the system works, most of the time, as long as trust holds, as long as refinancing remains possible, as long as the loop keeps turning. But when trust breaks, the architecture reveals its fragility. Yields speak long before anyone else does. They shift quietly, sending signals that ripple through the global financial surface. A low yield whispers stability. A rising yield suggests uncertainty. A steep curve says growth may accelerate. A flat curve implies hesitation. And an inverted curve, the rarest shape, reflects deep caution. But yields are not predictions. They are measurements of collective expectation. Millions of decisions compressed into one number. The 10-year Treasury is the clearest example. It is not simply the borrowing cost of the United States. It is the anchor reference for mortgages, corporate loans, municipal funding, and global trade pricing. When the 10-year rises, every credit instrument in the world readjusts its position by fractions of a percent to stay aligned. This is why yields behave like a language. They communicate trust in a more precise way than speeches, reports, or forecasts ever could. Consider the yield curve, a line connecting the borrowing costs from short-term maturities to long-term maturities. For decades, the curve has moved like a slow tide. When the short end falls below the long end, confidence in future growth is intact. The system breathes smoothly. Liquidity flows outward. But when the curve inverts, the signal shifts. Short-term yields rise above the long-term. The tide folds inward. The system holds its breath. Historically, this pattern often appears months before recessions begin. Not because traders see the future, but because the curve captures how money prefers to wait rather than expand. Every major economy watches this shape. Every central bank responds to its movements. And every institutional investor calibrates risk by reading this silent language. Yields create a common reference point that crosses borders without translation. They synchronize decisions between lenders and borrowers, governments and markets, expectations and realities. And in doing so, they reveal something subtle. Trust is not static. It is always in motion, always communicating through shape, tone, and level. The world does not speak one financial language. It speaks many. But the yield curve is the one sound everyone hears. Let's focus on the United States, because its debt structure explains how the global system really operates. The US owes $38 trillion,
But the mechanics of that debt are more complex than the number suggests. Think of it as a 3-layer engine, each layer feeding into the next. Layer 1. The Treasury issues bonds. Those bonds are bought by investors, banks, pension funds, foreign governments, insurance companies. From the Treasury's perspective, this is debt. From the buyer's perspective, it's an asset, the safest asset in the world. Layer 2. Banks hold these bonds as reserves. They use them as collateral. They borrow against them. They lend to customers. Those customers deposit money back into banks, so the bonds circulate from Treasury to banks to depositors, then back through the system again. Layer 3. The Federal Reserve stands ready. When markets need liquidity, the Fed buys bonds. It creates new dollars to pay for them. Those dollars enter the banking system, which then lends them out. So the Fed doesn't just manage money, it recirculates debt. It converts bonds into cash, cash into loans, loans into deposits, deposits back into bonds. It's a closed engine, self-sustaining, self-reinforcing. And here's the key. Most of this happens domestically. About 2/3 of publicly held US debt is owned by Americans. Banks, funds, institutions, the Federal Reserve itself. Only about 1/3 sits in foreign hands. Japan, China, the UK. So when people say America owes trillions to China, that's true, but it's only about 800 billion, roughly 2% of the total. The vast majority of US debt is owed to Americans, or to the Federal Reserve, which means the government. So the US owes itself, through layers of intermediaries, through institutional circuits. The debt is real, the interest payments are real, but the creditor is mostly internal. This creates a strange stability, because default becomes almost impossible. If the US defaulted on domestic debt, it would destroy American banks, American pensions, American institutions. The damage would be self-inflicted, catastrophic, unthinkable. So the debt rolls over, continuously, indefinitely. Old bonds mature, new bonds replace them, interest gets paid, the cycle continues. And because the system is internal, refinancing always works. There's always a buyer. The Fed ensures it. Now here's where it connects to the global system. Other countries hold US bonds as reserves. They need dollars for trade, for stability, for liquidity. Those reserves are denominated in US debt, in Treasury bonds. So the global financial system depends on US borrowing. If the US stopped issuing debt, other countries would lose their reserve assets. This makes US debt a global public good, a shared resource, essential infrastructure for international finance. The 38 trillion isn't a burden to the world. It's a foundation, a store of value, a source of liquidity. And the recirculation engine keeps running. Bonds issued, bonds bought, bonds traded, bonds refinanced, layer feeding layer, circuit reinforcing circuit. This is how modern finance works, not through repayment, but through continuous motion. As long as the engine runs, the system functions. But the US isn't alone in this. Every major economy operates similar engines, and those engines are connected through trade, through currency flows, through global markets. Let's look at how those connections work. Global finance has a center of gravity, and that center is the US dollar. Not because it is perfect, not because America is without flaws, but but because the dollar system is the deepest, most liquid, most trusted settlement network ever created. Behind that network stands one instrument, the US Treasury bond. Nations do not hold treasuries only to earn interest. They hold them because treasuries function as the world's ultimate collateral. A bank in Europe making a large corporate loan may use US treasuries as the anchor asset to secure the transaction. A pension fund in Asia may rely on them to match long-term liabilities. A sovereign wealth fund in the Middle East may hold them as a stabilizer during volatility. Treasuries provide liquidity, security, and universal acceptance. During global stress, demand for treasuries rises, prices increase, yields fall. Not because the world loves debt, but because it trusts the structure beneath it. The dollar system extends even further through the euro-dollar market, a vast offshore network where dollars circulate outside US borders. Here, banks lend dollars that technically do not exist inside the United States. They create them through contracts and extinguish them through settlement. This system only functions because treasuries provide a common reference point for valuation and risk assessment. During crises, the Federal Reserve opens dollar swap lines with major central banks, allowing them to borrow dollars and stabilize their own institutions. This happened in 2008, again in 2020, and briefly in 2022 as energy prices surged. Each time, the world looked not to gold or to regional currencies, but to the US Treasury market as the stabilizing anchor. This does not mean the dollar's dominance is permanent. It means the current architecture still relies on US debt as the primary settlement layer. Other systems may evolve, but for now, treasuries remain the quiet core of global finance. A core built not on sentiment, but on depth, predictability, and a long record of honoring obligations. This is why the world needs US debt, not as a burden, but as the operating system for modern economics.
The global financial system isn't a hierarchy, it's a network, a web of connections where each node stabilizes the others. Think of it like an electrical grid. Power flows between regions. Excess capacity in one area feeds demand in another. Outages in one place ripple through the network. The same logic applies to debt. Japan lends to the United States by buying treasury bonds. The US lends to Europe through the International Monetary Fund. Europe lends to developing nations through the World Bank. And developing nations, they lend back to advanced economies. By accumulating foreign reserves, dollars, euros, held in the form of government bonds. So the flow is circular, not hierarchical, not one-directional. Japan needs US bonds to manage its currency. The US needs Japanese demand to keep interest rates low. Europe needs IMF authority to stabilize the Eurozone. The IMF needs US backing to maintain credibility. Every link depends on the others. This creates stability through interdependence. No single country can walk away. No single institution can collapse without affecting the whole network. But it also creates vulnerability, because stress in one part spreads through connections, through correlations, through cascading effects. Let's trace one path. A crisis starts in a developing country, maybe Sri Lanka or Argentina. They can't repay foreign debt. They default. Foreign investors panic. They withdraw capital, not just from that country, but from similar countries, from all emerging markets. This triggers a currency crisis. Currencies collapse. Import costs spike. Inflation rises. Governments can't import essentials, fuel, food, medicine. Social unrest follows. The IMF steps in with emergency loans, but the loans come with conditions: austerity, reforms, spending cuts.
The country accepts, implements the changes. The crisis stabilizes, eventually. But the ripple doesn't stop there. European banks held bonds from the defaulted country. They take losses. Their share prices fall. Investors worry about contagion. Credit tightens across Europe. Interest rates rise. Growth slows. Unemployment increases. The European Central Bank responds, buys bonds, lowers rates, floods markets with liquidity. The US Federal Reserve watches, adjusts policy, coordinates with the ECB. The crisis stabilizes, but it took coordination across continents, across institutions, across markets. This is the interlocking nature of global debt. What happens in one country doesn't stay there. It travels through bonds, through currency markets, through trade relationships. And the system handles these shocks most of the time because the connections allow for mutual support. When one region struggles, others provide capital, demand, stability. But the connections also mean contagion. One failure can cascade. This is why central banks coordinate, why the IMF exists, why the World Bank operates, why G20 meetings matter. They're not managing individual countries. They're managing the network, ensuring the connections hold, ensuring the circuits keep flowing, ensuring the system remains stable. And most of the time, it works. The 315 trillion circulates through nations, through institutions, through markets. Each transaction creating new connections, each bond linking creditor to debtor, each refinancing renewing the network. The system is resilient, not because any single part is strong, but because the whole is interconnected. Remove one link and others compensate. Stress one circuit and others absorb the load. This is the architecture that sustains global debt, not through strength, but through balance, through interdependence, through mutual reinforcement. And it endures, not because it's perfect, but because no one can afford for it to fail. Let's shift focus from mechanics to psychology, because markets aren't just numbers, they're collective emotions. Every bond price reflects a judgment about risk, about trust, about the future. But those judgments aren't purely rational. They're influenced by fear, by hope, by momentum. This creates patterns, predictable, powerful, and sometimes dangerous. Here's how it works. When markets feel calm, investors take risks. They buy bonds from shakier countries. They accept lower yields. They assume stability will continue. This behavior is called risk-seeking or reaching for yield. Investors know the bonds are riskier, but they believe nothing bad will happen, at least not soon. So they accept the risk. This pushes prices up, yields down. Borrowing becomes cheap for everyone. Governments take advantage. They borrow more, issue more bonds, fund more projects. Debt grows, but markets don't care because confidence is high. Then something changes. Maybe a default somewhere. Maybe a political crisis. Maybe inflation data. Suddenly, investors reassess. They realize risk wasn't priced correctly. They panic. This is called flight to safety. Investors sell risky bonds, buy safe ones. US Treasuries, German Bunds, Swiss bonds. The shift happens fast, within days, sometimes hours. Yields on risky bonds spike. Borrowing costs explode. Governments can't refinance, and the panic becomes self-fulfilling.
Rising yields make default more likely, making investors more nervous, driving yields higher. It's a feedback loop, and it can destroy an economy in weeks. This is behavioral economics in action. Markets overreact, both up and down. During calm times, they price risk too low. During crises, they price it too high. Neither reflects true economic fundamentals. Both reflect collective emotion. And here's the key: nobody intends this. No single investor wants a crisis. But when everyone makes the same decision simultaneously, the system breaks. It's called herding, following the crowd, because the crowd feels safe. But herding creates volatility, because the crowd can turn instantly. One moment, everyone is buying. The next, everyone is selling. No middle ground. This makes bond markets incredibly powerful and incredibly unpredictable. They don't just respond to economic data, they create economic reality. If markets believe a country is risky, borrowing becomes expensive. Expensive borrowing slows growth. Slow growth increases deficits. Larger deficits prove the market right. The belief creates the outcome. This is why central banks intervene, to break these feedback loops, to stabilize psychology. When markets panic, central banks buy bonds, signal confidence, provide liquidity. This reassures investors, calms the herd, stops the spiral. Without central bank intervention, market psychology would destabilize the entire system, because the psychology is contagious. Fear spreads faster than data, panic travels faster than reason, and once started, it's hard
to stop. Unless someone acts decisively. This is the hidden layer beneath global debt, not just mechanics, but emotions, collective belief, shared psychology. Understanding the 315 trillion requires understanding fear, understanding confidence, understanding how crowds behave. Because in the end, debt markets are human, and humans aren't always rational. Central banks occupy a unique position. They're neither fully government nor fully private, neither purely economic nor purely political. They operate through balance sheets, through assets and liabilities, through creation and destruction of reserves. But what they really do is more subtle. They manage breathing rhythms of liquidity, of credit, of confidence. Let's break this down. When a central bank buys bonds, it credits the seller with reserves. Those reserves are new, created from nothing, but they're not money in the traditional sense. They're capacity, room for banks to lend, oxygen for the financial system. Banks use reserves to settle payments, to meet requirements, to maintain operations. More reserves mean more lending capacity. Less reserves mean tighter credit. So when a central bank buys bonds, it expands capacity. When it sells, it contracts. This is called open market operations, but the name doesn't capture what's really happening. The central bank isn't just moving money around, it's adjusting pressure in the system. Like a regulator on an oxygen tank, too much pressure and inflation rises, too little and credit freezes. The central bank's job is to maintain balance, not too hot, not too cold. And it does this through its balance sheet, which grows and shrinks, expands and contracts. During crises, balance sheets explode. The Federal Reserve's balance sheet went from less than 1 trillion to 9 trillion during the pandemic. It bought bonds, bought mortgage securities, bought corporate debt, all to inject capacity, to keep credit flowing. Then, when stability returned, it began shrinking, selling assets, withdrawing reserves, tightening capacity. This is called quantitative tightening, the opposite of quantitative easing, but both are the same mechanism, just in reverse. And here's what matters. This capacity creation doesn't come from anywhere. It's not backed by gold or reserves or anything physical. It's backed by authority, by law, by the central bank's monopoly on reserve creation. So when people say central banks print money, that's not quite right. They don't print currency, they expand capacity. Banks then use that capacity to lend, and lending creates money in the form of deposits. So the money creation happens 2 steps removed. Central bank creates reserves, banks create deposits, but both are essential. Without reserves, banks can't lend. Without lending, deposits don't grow. The system depends on this 2-layer structure, and central banks control the first layer through their balance sheets, through their bond purchases. This makes them incredibly powerful, more powerful than governments in some ways, because governments need approval to spend, need legislation, need votes. Central banks just act, buy bonds, expand balance sheets, inject capacity. And the effects are immediate. Markets respond within minutes, within seconds. This is why central bank meetings move markets, why statements matter, why forward guidance shapes expectations. Because central banks don't just manage reserves, they manage belief about future policy, about future capacity. And belief shapes behavior, shapes lending, shapes investment, shapes growth. So central banks are balance sheet alchemists, turning promises into capacity, capacity into confidence, confidence into stability. But alchemy has limits, and those limits become visible during crises. Money today does not move the way it once did. It no longer flows from mint to bank to pocket. It moves as entries, adjustments, and reserves inside balance sheets. Quantitative easing and quantitative tightening are the clearest examples of this new mobility. When a central bank buys government bonds, it does not print money into the physical world. It replaces a bond with a reserve balance inside the banking system. One asset transforms into another, like shifting weight from one side of a scale to the other. The total capacity changes, the plumbing changes, the rhythm of liquidity changes. This is why QE is best understood as a breathing motion. When the central bank expands, it increases the system's capacity to absorb pressure. When it contracts, the system tightens, reducing the flow. Japan's example is the clearest case. For years, the Bank of Japan has purchased bonds to keep yields near zero. This policy has reshaped global flows, pushing investors to seek returns abroad. The effect is subtle but powerful. QE in one country can influence risk appetite halfway across the world. QT reverses the motion. Reserves shrink, liquidity drains, financial conditions tighten. Neither QE nor QT is about money creation. They are about the mobility of safety, where it sits, how it flows, and how quickly the system can breathe. In this way, central banks act less like printers and more like oxygen regulators. Their decisions set the tempo of the entire system, and the world adjusts with each breath. Let's look at what happens when the system breaks, when trust evaporates, when refinancing stops. Greece, 2010. The government's debt exceeded 130% of GDP. Markets panicked. Yields spiked above 30%. No country can sustain that. It's a death sentence. The European Central Bank and IMF intervened, provided emergency loans, but imposed harsh conditions: tax increases, pension cuts, wage freezes, privatizations. Unemployment soared. the economy shrank for years. The rescue stabilized the debt, but destroyed a generation's prospects. Argentina, 2001. A similar pattern. The government defaulted, the peso collapsed, banks froze accounts, savings evaporated overnight. Riots erupted, the government fell. And yet, Argentina recovered, slowly, painfully, by restructuring debt, negotiating with creditors, rebuilding trust. Then it happened again, 2020, another default, another crisis, another restructuring. The cycle repeats because the structural problems remain. The currency is weak, exports are limited, debt is in foreign currency. Any shock triggers collapse, and recovery requires external help. Sri Lanka, 2022, the newest example. The government ran out of dollars, couldn't import fuel, couldn't import food, power outages, shortages, social unrest, political collapse. The IMF arrived with loans and conditions, reforms, subsidy cuts, tax hikes. The pattern is always the same: crisis, panic, intervention, austerity, slow recovery. These aren't isolated failures, they're built into the system, because not every country can maintain stable debt. Some have structural vulnerabilities, dependence on imports, weak currencies, political instability, poor institutions. These vulnerabilities make crisis likely, almost inevitable. And when crisis hits, the creditors become visible. The IMF, the World Bank, the rating agencies, they impose terms, set policy, restructure debt. Democracy becomes secondary, market demands primary. But here's what's important to understand. These crises don't threaten the global system. They're releases, pressure valves. One country defaults, others adjust. Capital flows elsewhere. The network rebalances. The system survives, even thrives. Because failures remain isolated. As long as major economies stay stable, peripheral crises are manageable. This is why the 315 trillion keeps growing, despite defaults, despite crises, despite collapses, because the system is designed to absorb shocks, to isolate failures, to continue functioning. It's not fragile, it's anti-fragile, getting stronger through stress. But that doesn't make the human cost any less real. Unemployment, poverty, despair, those are the price of system stability, paid by those least able to afford it. This is the dark side of global debt, the side that doesn't appear in statistics, but it's part of the architecture, part of how the system maintains itself, through discipline, through pain, through sacrifice, all calibrated to keep the larger structure intact. Defaults appear different on the surface, but beneath that surface, they often share one repeating pattern. Three forces converge. External dependency. A country relies heavily on imported fuel, food, or manufacturing inputs. Currency mismatch. Its debts are denominated in a stronger foreign currency. Yield shock. Global financing costs rise faster than domestic growth. When all three tighten at once, the system strains. Greece in 2010 saw yields spiral upward as confidence evaporated. Imports became expensive, lending collapsed, and emergency support became unavoidable. Argentina faced repeated cycles of currency mismatch and foreign-denominated debt, each tightening until restructuring was the only path forward.
Sri Lanka in 2022 lost access to fuel imports, triggering food shortages, currency collapse, and debt distress. Turkey experienced currency pressure as yields abroad rose, forcing difficult trade-offs between inflation control and economic activity. Each crisis is unique, but the underlying structure remains familiar. External dependence meets currency mismatch. Yield shock meets domestic constraints. Understanding this pattern does not prevent crises, but it reveals why they emerge and why they repeat. The architecture creates the outcomes, and once the pattern is visible, the system becomes less mysterious and easier to interpret.
Let's address the central misconception that debt should be repaid, that carrying balances is irresponsible, that governments should balance budgets. This makes sense for households, for individuals, for businesses, but governments operate differently, by necessity, by design. Here's why. A household repays debt to eliminate the obligation, to free up future income, to reduce risk. But a government's goal isn't to eliminate debt, it's to maintain capacity, to preserve options, to ensure stability. Repaying debt would require massive surpluses, which means higher taxes or lower spending, or both. Either choice slows the economy, reduces growth, increases unemployment. And here's the deeper problem. If a government paid off all its debt, what would replace government bonds? Banks hold them as safe assets. Pension funds rely on them for stable returns. Central banks use them for monetary operations. Remove government bonds, and the entire financial system loses its foundation. There would be no safe asset, no benchmark for pricing risk, no anchor for markets. Credit would freeze, interest rates would spike, markets would destabilize. Paying off debt would trigger a crisis worse than any default. This is why governments refinance instead of repaying. They roll over debt, issue new bonds to redeem old ones. The debt never disappears. It transforms, extends, continues. This isn't failure. It's the system working as designed. Because government debt isn't like household debt. It's infrastructure, a public good, essential plumbing for modern finance. Think of it as the bloodstream of the economy, always circulating, never empty, always under pressure. Remove the blood, and the body dies. Remove the debt, and the economy collapses. So governments do the opposite. They maintain debt levels, adjust them as needed, but never eliminate them. And investors don't expect repayment. They expect refinancing. They buy a 10-year bond, not to be repaid in 10 years, but to buy another bond when it matures. The relationship is permanent, continuous, self-renewing. This is how Japan operates, with debt exceeding 250% of GDP, yet interest rates near zero. This is how the United States operates, with 38 trillion in debt, yet borrowing costs historically low. This is how the system operates everywhere, through perpetual debt, through continuous refinancing. And it works, not perfectly, but sustainably, as long as interest payments remain manageable, as long as growth continues, as long as trust holds.
The numbers can expand indefinitely because the system isn't constrained by repayment. It's constrained by servicing costs, by the ability to pay interest. And interest rates depend on trust, on market confidence, on central bank policy, all of which are manageable, adjustable, controllable. This is why the 315 trillion keeps growing and will keep growing, not as a crisis, but as expansion, as capacity, as the natural state of modern finance. The plan was never to pay it back. The plan is to maintain it, to manage it, to use it. And as long as that plan works, the system endures. This reassurance matters, not because markets need comfort, but because participants need a reference point, a signal that the calibration has not broken. Trust is not a single choice. It is an ongoing relationship, a quiet negotiation between governments, investors, institutions, and central banks. Think of it as a long bridge. Each pillar supports the next. If one weakens, others absorb more weight. If too many strain at once, the whole structure trembles. But the bridge holds because people adjust. Engineers reinforce. Traffic redistributes. Weight shifts to where it needs to be. In finance, trust behaves the same way. When a government falters, investors demand higher yields. When yields rise too quickly, central banks step in. When intervention restores calm, confidence returns. The calibration resets. This is the deep architecture beneath global debt, a system held together by coordination, reinforcement, and quiet adjustment. No one controls all of it. No institution commands the whole. Yet the network, through constant calibration, remains coherent enough to function. This is why $315 trillion in global debt has not collapsed the world economy. It persists because trust adapts. Trust does not require perfection. It asks for predictability, transparency, responsiveness, a shared sense of how others will act when pressure rises. Countries with stable institutions earn trust. Nations with turbulence lose it. Yet both remain part of the calibration, shaping and reshaping the architecture with every decision. And now, as you listen, you are seeing this system at its deepest layer, a financial world held together not by money, but by coordinated expectations. There is no vault large enough to secure the global economy. There is only the architecture of trust, a living structure we built each day through millions of choices. And when you understand that, the scale of global debt becomes less threatening and more understandable. Not a monster, but a mirror, reflecting what the world believes about itself. Now that this foundation is clear, we slow down and begin the final descent, a softer space where the mind can rest and the ideas can settle into quiet understanding. Trust does not live in speeches or headlines. It lives in instruments most people never notice. Credit default swaps measure the cost of insuring a country's debt. When the spread widens, concern rises. When it narrows, confidence returns. FX swap basis reveals stresses in global dollar funding. A deep negative basis signals acute demand for short-term dollars. Repo haircuts measure collateral quality. When haircuts rise, institutions pull back.
reducing leverage and tightening liquidity. Ratings translate complex conditions into a single signal, not perfect, but widely used as a baseline. Each of these instruments acts like a sensor, capturing how the network feels about risk. Together, they form the hidden architecture of trust, a system constantly recalibrating beneath the surface, not dramatic, not visible, but essential. And once you understand these quiet measurements, the financial world comes into sharper focus. Trust is not mystical. It is structured, coded, observable. If you know where to look, let your mind loosen now. The concepts can rest. The loops can soften. You have walked through systems that usually stay hidden. Circuits of trust, networks of credit, flows of promises moving quietly across nations. And now, the system grows still. The pace slows, like markets settling after a long day. Breathe gently, in and out. Feel how the body relaxes when there is nothing left to solve, nothing left to analyze, only the soft understanding that the world holds itself together through balance, through rhythm, through trust. Debt at this scale is not a weight on you. It is a framework around you, an architecture quiet and continuous. The numbers fade, the charts fade, the urgency fades. What remains is a sense of structure, a sense of connection, a sense that the world, despite its complexity, is always adjusting, seeking equilibrium, just as you are now. Let your thoughts drift, the way markets close for the night, signals quiet, volume falls. Only the slow breathing of a system at rest. Let the imagery soften, the global circuits dim, the bond markets hush, central banks fall silent. Even the 315 trillion becomes only a distant shape, harmless in the dark. Here, you can release the loops, release the patterns, release the need to understand. You have already absorbed what was needed. The rest will settle on its own. The world continues turning, networks continue flowing, and the architecture of trust keeps adjusting, quietly, smoothly, beyond your attention. Your breathing slows, your thoughts drift, your body becomes warm and soft. Let the weight of knowledge fade. Let the rhythm of your pulse match the calm of the night. If sleep comes, let it come gently. If wakefulness lingers, let it linger softly. Nothing is required of you now. The system will continue without you, and you can rest in the quiet space between thoughts. Breathe once more, slow, steady, and free. And as the world's debt moves in its endless patterns, you drift into your own quiet loop, held by trust, held by calm, held by the quiet certainty that the world and you are both allowed to rest. Good night.